How do you value a business in a way that allows you to both understand opportunities like Amazon presented in the early 2000s when it was plummeting money, but also still allow you to invest in companies like Apple when it traded at 15 times earnings in the early 2010s? Many investors sort of fall on their own valuation methodology and they get too pigeonholed in that. There is no one size fits all approach. And so in this video, I want to talk about how to better form the valuation process to each individual business because it is not the same for every business. And so I'm going to give you a lot of short examples in this video of different ways to think about valuing different businesses. The first one is going to be Floor Decor. For those that don't know, that is a specialty hard surface flooring retailer. Their value prop is basically to have the most in-stock inventory, the most selection, and the best money for value. And now that is really important because if you're a professional who buys flooring, you usually don't have places to store flooring. And so you want to be able to go and pick it up the same day and then go do your job. And so that's why it's really important they have everything in stock. What allows them to have everything in stock is their stores aren't stores, they're warehouses. So very similar to Costco. So they can carry a lot of inventory. They have a lot of selection, so it's not going to be a problem finding what you want. And their scale allows them to offer the best prices. And so that is what it is very simply. Now, how should you look about this business? Because if you went ahead and pulled up the financials, you'd see pretty low margins, mid-single digit operating margins. Revenue growth has kind of been a little bit meh lately because housing has been kind of weak. It really wouldn't look like that exciting of an opportunity. Maybe a 40 or 50 times earnings multiple, depending on when you're looking at it, and not growing that much. So it would look like, what are you doing here? It kind of wouldn't look like something even worth digging into more. However, if you did decide to dig into it more, what you would find out is that in the past couple years, after a big COVID boom led to a lot of people redoing their floorings, a lot of home refurbishments, and a very elevated level of home sales with low mortgage interest rates, the reverse then happened. Very high mortgage interest rates stop people from wanting to sell their homes. When you sell a home is actually a time where people tend to either redo their flooring because they want to get a higher price to sell it, or someone just bought the home apartment and want to redo the flooring. So that's the most common time people do that. It's a trigger event. And so all that elevated activity plus a very soft housing market meant that their sales in existing stores have been very soft and have actually fallen for a couple years. Now, that's not going to be a long-term thing though. That's just a little bit of cyclicality in the business model. When you are thinking of flooring, it's something that's good for 20 years just about. So if you have to defer it another year or so, that's not really a big issue. People will do that if they're in tough times. But eventually, you're going to want to replace your flooring. And when you do, you're going to want to go to the place that has the most selection and the best prices for the best quality. And so eventually, they're going to capture that sale. It's just going to be a little bit of time. So if you're looking at them today and you believe in their value prop, how should you value them? What I would recommend in this case is you look at how many stores they have, what their sales per store are, what you believe their sales per store could be, and how many stores they plan on having. So right now they have roughly 250 stores. They plan on getting to 500 stores in just the US. Their stores on average do 22 million in sales per store. At peak, that used to be 28. And so they do believe that once the housing environment improves and all that, they should be able to get more sales per store. On top of that, you have all these opening store costs, which once the stores open are going to go away. And so you could strip those out because if you're putting a multiple on a one-time expense, what you're basically implying is that that expense is going to happen forever. Of course, it's not though. It's one time. And so if you want to look at Floor Decor, what I would do is I would look at their store target of 500, what you believe they could do in sales per store at maturity. Maybe it's 30 million, maybe it's 25 million. So you multiply those two numbers together, and then you apply a mature margin. That is the margin you think they could achieve when they're not growing that much. I think 15% is probably a practical margin. If you want to be conservative though, you can pick something lower. So all you do is you just multiply those three numbers together, stores, sales per store, and operating margins, and that'll get you operating earnings. Then you just tax that, and that is how much you believe they can make in earnings power in the future. You could then put a conservative multiple on that, 18 times if you want, 20 times, whatever you pick. If you do that math, you're going to get roughly a 25 billion market cap versus I believe it's 10 billion-ish today. And then you could say, okay, how long is this going to take? Maybe 10 years. What does that return look like if you take the 25 billion in future market cap and then divide by the 10 billion? And then you could get what you believe your return will be. That is one way you look at a business, and it's very different than just looking at the current earnings multiple of maybe 50 times, which is not going to have you be interested in it. Another business, AppFolio, they do vertical market software for property managers, specifically small and medium property managers, but they're moving up to larger ones. And so what that basically means is if you own a lot of property, usually hire a property manager. The property manager wants software to help run the business, checking who's paying rent, if there's maintenance issues, leasing, getting new tenants in, tenant screening, all sorts of different things involved in running many different real estate units. They do the software for that. It's very sticky because once you get embedded in the system, you tend to never really want to switch out, but also they innovate a lot. They're known to have kind of one of the better products right now. And so it's very unlikely you're switching because you're dissatisfied with that. And then on top of that, they continue to roll out new features that they can cross-sell into their existing user base. Two things popular as of late has been a sort of third-party app network. And so from the dashboard of their software, you can now connect to all these different third-party apps, pull in all sorts of different functionality, and people have really enjoyed that. And then something else, they're doing a lot with AI now. AI is helping people lease, helping respond to leasing inquiries, maintenance requests, all sorts of stuff. And so that is the business. If you're looking at it when my research company, Speedwell Research, looked at it, which by the way, you can find out more about in the show notes below, it traded at around 7 or 8 times sales, which sounds very high. And, it can be high in absolute. Different investors have to take different opinions on what they want to pay for something. But the way I would recommend you look at it is not a sales multiple. Instead, what you do is you think, what would this company look like at maturity? Because a lot of software companies, they run a lot of R&D and sales and marketing, and they won't necessarily have to keep that going just to service their existing business. Because I said it's a very sticky software business. And so they could turn down a lot of their marketing and their profit margin would go up. And they could do that without losing any sales. And so a lot of the money they're spending is to grow. And so the growth is hiding the underlying profitability of the business. And so that is why you could look at what is called a mature margin framework. What that basically means is you do a little bit of math to figure out what you think the margins are at maturity. You could look at peer software companies, see what they do. You could try to make your own estimates on how much you think marketing is for maintenance versus growth. So you strip that all out and maybe you get to 40% margins, 30% margins, whatever it is. And you could actually just take the current sales and multiply it by that mature margin to get a current kind of steady state earnings figure. Now, if you did this, for example, you might find that 8 times sales really translated to 25 times earnings. That may not be that bad if the company is growing 15% plus and you believe it can for a long period of time. I'm not here to give you any sort of opinion on what I think about these stocks. I'm just trying to give you a different framework to think about them. It's not about you agreeing or disagreeing with the valuation. It's just understanding different ways to value businesses. You get to make your own decisions as an investor. Now, another one, if you're looking at Meta, something I like to do is what's called the reverse DCF. So if you've heard of a discounted cash flow statement, that basically just means you're estimating out cash flows and then you discount them back to today. If you're interested, I'll make a video in the future explaining the DCF and the reverse DCF in detail. So comment below if you want to see that. But for now, just know that when you do a DCF, you have to assume a return you want and it spits out a valuation. When you do a reverse DCF, it does the opposite. You start with the current valuation that the market gives you. And then you could put in different assumptions for revenue growth, margin, and then you get a return as an output. I prefer looking at it this way because instead of me saying I have to buy Meta at a $600 stock price to get a 10% return to make up numbers, what I could do is I could say if I'm buying at a $600 stock price, I need at least 15% revenue growth to get a 10% return. Okay, that's kind of easier, in my opinion, at least, to kind of conceptualize this. And so the way I do the reverse DCFs in my research reports at Speedwell Research is I will sensitize across all these different scenarios. So I could say, what does a return look like if you do 6% revenue growth, 10, 20, and then it fades, and then margins are 35, 40, 50. And you could see these different scenarios, and the output is basically a table of returns. And when you're looking at this table of returns, it's kind of, in my opinion, again, a little easier to say, oh, if I'm assuming 20% growth, that's kind of a lot of growth, and I'm only getting a 7% return, that's not so interesting. If I'm assuming on the other end, though, which was the case when we originally did this analysis in January 2023, was that you only had to assume 3% growth to get a 10% return. And, the market historically has returned about 9%. So you're getting above average market return for only assuming 3% growth. How hard is it for a company like Meta to grow 3%? Well, many people thought that they were really doomed at the time, but if you did the reverse DCF, you would have maybe seen that that's really not that much to assume. I'm very comfortable assuming that. And in another way, you could think of a low assumption as being your margin of safety. This is really key because a lot of times people think of a margin of safety as being a discount to what you are buying a stock price at. And it is still that. But I think another helpful way to think about it is when you lower the assumptions you need to make in order to get a return, and that return is still a good return, then that is what your margin of safety is. And so if Meta only had to grow 3% to get an 11% return, and you really thought, they should grow at least 10%, that's your margin of safety, is that they don't need to grow 10%. They just need to grow 3. And so that's another way to look at it, the reverse DCF. Just one more is going to be Google. That one you probably want to do something more like a sum of the parts analysis. Now, I usually don't love sum of the parts analysis because when people do them, they kind of just assume all of this excess value is going to get unlocked. But usually what ends up happening is you have, a bad asset that's not producing that much earnings. You have another one that it's kind of losing money. And you have another one that's kind of overlooked. But there's no reason to believe management is ever going to do something to unlock the value, to pull apart, the bad asset from the good asset. And so that's why I'm not usually a big fan of some of the parts analysis. But in the case of Google, if you were looking at them, you should have seen that Google Cloud for at least the past few years was losing money, and it wasn't going to lose money forever. They would either shut it down or get to profitability as they scaled. The same thing too with Reality Labs, by the way. They're losing 18 billion a year. Mark Zuckerberg's not going to lose 18 billion a year for 50 years, which is, if you're doing a DCF, what it would imply. And so you could say, I don't know what's going to happen with Reality Labs and not want to assign value to it, but you shouldn't assign a massive negative value to it. That's a mistake because, again, they're not going to be losing money forever in it. It either works and it's profitable, or they're going to shut it down eventually. They're not going to lose that amount of money forever. And so same thing with Google. You're looking at Google Cloud. It was losing money. Pretty likely it would be able to turn a profit, but at the very least, they wouldn't lose that money forever. The other bets, well, it's a little different because they kind of have been experimenting and losing money there for a long time. So maybe you don't want to actually back that out. And you want to say, I think they will continue experiment and lose some money. Other assets, though, like Waymo, would really not be showing up anywhere in your valuation. And so for a long time, people probably didn't attribute any value to that. But now it seems like there's certainly some, because not just do they have autonomous vehicles, I think even the bigger aspect too, because we'll see whether or not autonomous vehicles becomes commoditized technology, they have a consumer app that's getting a lot of traffic, and that consumer touch point is very valuable. Especially with technology, getting a successful consumer app is a very high value place to be. And so even if it's not an autonomous vehicle you end up ordering, who knows, maybe they add deliveries from robots to the Waymo app. And so you have all sorts of different things you could do once you're in that position. Maybe you partner with other autonomous vehicle operators and you just take a fee for a booking or something like that. And so it's a good place to be. YouTube too, which even though they report revenue, you actually don't know margins on that business. And for a very long time, they've been, arguably under earning in that business. And so that's something else you could say, what do I think margins on YouTube really should be? And so in your sum of the part analysis, you're maybe valuing cloud separately, search separately, maybe Waymo separately, and then maybe you're adding a negative net present value because of all the other bets that you think they'll lose money on. But sometimes you do get lucky and you could just look at the earnings multiple or the free cash multiple of the business. And when that is the case, of course, it is much easier to sort of value that business. If you have any other questions though on everything I talked about here, I do plan on making many more videos touching on all these topics, but help tell me what you want to learn more about by dropping any comments or questions below in this video. And if you want to join us and continue to learn more about investing in business, go ahead and subscribe and like this video.